Hello and welcome to my YouTube video. So in today's video we're going to talk about top 5 things that every investor needs to do before they actually start investing. So whether you're a seasoned investor, whether you're brand new to investing or you have zero experience in investing, these are my top 5 things that every investor should do before they actually go ahead and make that first purchase in that stock. So the first thing that we want to talk about is research. Now this is one of the most important things that any investor should do. So you should be able to know what's happening, understand the markets. And so with research, it allows for you to actually understand exactly what is happening in the stock market. It tells you everything from a broad scale as to what has been happening externally to the stock markets, to a much smaller detail to that index that you're interested in investing in, that industry that you're interested in investing in, and also that stock that you are interested in investing in. So once you do the proper research, you really just need to understand the market. So you need to know whether it's a boom that's actually happening in the stock markets or it's actually a bear market. So a bust maybe just occurred. And so booms usually just means rapid growth over a period in a set time, and bear markets usually means that investors are a bit more cautious, and so funds are actually less flowing within that market, and so the volume will be much lower, the activities, the daily trades, and just all that excitement and creativity that's happening in the stock market will not be there in a bear market. And bear markets are one of the best markets to really learn and understand, because it teaches you patience. It allows for you to test out different trading strategies, whereas if you were investing in a boom market, then more than likely most a few strategies that you would have tested out would actually have been paying off, because when the market is booming, there's a lot of excitement that's happening. Persons are happy, persons are able to feel like an investor. And honestly, boom markets let anyone feel like a true investor, because you can make money in a boom market. You can make 30, 40, 50% and even so much more in a bull market in such a short period of time, whereas in the bear market period you would have to actually be a little bit more patient. You'd have to do more research, do more due diligence on the investments and the industry and the stocks that you actually are investing in. And so these are just a few things, but the research that you do overall, understanding exactly what is happening, understanding the economic climate that the country is in, and exactly what is happening with the Nasdaq and the S&P 500 indexes. These, along with the research, should allow for you to be much more confident and know exactly what is happening in the market. And so the second thing that reason what you should do before investing is actually speak with a financial advisor. So Robert Kiyosaki, in one of his books, actually had highlighted that you should speak to about 5 to 6 different financial advisors before you actually start investing. So if you are brand new to the stock market, or maybe you have very limited to no knowledge, then this is very crucial for you. You see, each advisor has their own traits, their own style, their own way of doing things. And so if you have very limited to no knowledge in investing, you want to ensure that the person that you are speaking with has your best interests at heart. And so what you really are looking to do is just to have a connection, to feel listened to feel heard, to feel like when you speak to this person and you sit down in front of them and they say, what are your objectives, what are your goals, and you say, at this point I really don't know, they are able to have that initial conversation with you and be able to actually, at the end of that conversation, know you a little better, and you'd be able to start building on that relationship, having that trust with that person. And so they would be able to now be able to advise you exactly as to how to reach your financial needs. And so the relationship wouldn't just come within one initial meeting. You should have follow-up meetings with the advisors that you are testing with. But usually after about 5 to 6 advisors, you usually feel at ease. You feel a sense of calmness within you and at peace. And whenever you feel that way with a particular advisor, that's the one that usually you should go with, because that's the one that you feel the most connection with, the most at heart with, and the one that aligns with your goals and your objectives mostly. And so the third reason thing that you should do before investing is actually understanding the interest rate. So interest rates play a significant impact on the stock markets. When interest rates are high, the markets tend to be slower, and when interest rates are low, the stock markets tend to be more vibrant, more active. A lot more is going on in the market. And the reason for this is that if you have a mortgage or a motor vehicle loan or any type of loan out there in a high interest rate environment, you will be less likely to actually borrow. And during high interest rates environments, you'd actually be paying more to invest within these periods. And during periods of low interest rate environments, you will actually have more funds to spare, and so you actually will be more inclined to borrow. And so with this, with borrowing and with the amount that you'd actually be repaying on these loans, it would actually significantly affect your investment. So if you are borrowing in a high interest rate environment, naturally you will have less funds to spend. And if you borrow during low interest rates, then you will have more funds available to invest and to spend. And the fourth thing that you should do before investing is actually know about the inflation rate. Now, in the United States, the inflation is really tracked by the CPI, and that's the Consumer Price Index. And what that is, it's just a collection, a basket of ingredients that are calculated, and the price movements are calculated over a month by month basis and a year to year basis. And so naturally, if inflation rate is high, you'll have less money available, and if interest rates are low, you'll have more money available. So let's look at an example. Let's say normally you'd go to the supermarket and you'd spend $100 on fruits and vegetables, and let's say for instance that the interest rates on the fruits and vegetables for over the previous month had actually increased by 4%. So what that means is, whereas you'd be spending $100 today or last month, today you'd actually be spending $104 average more on that additional, on the same ingredients that you get. So what the inflation rate really does is that it tells you that if inflation is high, you would be getting less goods and services for the same amount of money, or it costs you more to get the same worth of goods and services. So that really is what why inflation rate affects the stock market. So look at the inflation rates, and if you're unsure, just google it. Google CPI and it will show you CPI US, and it will share with you the actual inflation rate for the United States for the current period. And they have a full chart with a breakdown that tells you the month over month, so the change over the previous month and over the previous year and year to date. So these are things that you really should know before actually investing. And really, inflation just means if I have less money in my pocket, that means I'll be able to afford much less investment or much less stocks. So that really is it. And number 5, the fifth and important reason to know before investing is the jobs report. And so the jobs reports or economic data really just shares with you the amount of persons that are currently unemployed. So if the unemployment rate in the United States increases, then naturally the stock market would decrease as well, because less persons would be working. And so with less persons working, that means there is a strain on the persons that are able to invest, and as such the disbursement amongst persons would be significantly less. And so with job reports, if job reports are high, then naturally the stock market would perform a little bit less than average. And if job reports are lower, then so that is unemployment rates are lower, then the stock market would naturally rise. And it's just of the perceived value that the more persons that are working, the more persons that are earning would actually equate to more persons being able to actively invest in the stock market. And so their funds would then be able to really just go within the market and just move along with all the other investments that are there. So to really just be a part of that whole economic environment and state of mind. And so these are the top 5 things that I recommend that anyone who is interested in investing do. So they look at, to ensure that you do your own research, speak with a few financial advisors, know the interest rates, as the interest rates really affects the markets. Understand the inflation rate, and just know that in high inflation periods, stock markets tend to perform lower, and in lower inflation periods, stock markets perform higher. And number 5 is the jobs report. So the unemployment rate usually determines how well or active the market will be. So that's all for today. If you like this video, subscribe, give me a like, and subscribe so that you don't miss any other as they are appear. Take care. Bye.